Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. If you're looking for good investment opportunities, way undervalued investment opportunities, click subscribe to the channel. I can help you find those undervalued investment opportunities. They're typically in commodities right now. That's what's undervalued. And I scroll through, I read all your guys' comments, well, a lot of them. I am scrolling through the comments, getting your guys' questions. I'm going to chart out a bunch of subscriber picks, so that's good. Look for that soon. And I've seen a couple of different questions on what happens to commodities in the likely event of a stock pullback. There's something I want to show you in history. This is the Fred housing starts. I have it behind me right here. I'm going to shrink myself up and move myself over here. So that's the housing starts. And why is the housing starts important? I'm focusing on the expansion phase of real estate. And the expansion phase of real estate is when the housing starts is going up. Going up, going up, going up. See all that? Now, I want you to focus on something on this chart. Focus on the dark recession lines. These lines are recession lines on the chart. Every single time we go into recession, the housing unit starts goes down. Goes down. Look, down, recession. So this one went down and we didn't have a recession. Down, recession. Down, recession. Down, recession. Back down, recession. We were declining, recession. The only one that didn't was the 99.com bubble. Then we had another big recession here in 08 and 09. We are moving up. And whenever this is moving up, we've only had one recession. It was only contained to stocks. Then they said that they lowered interest rates, and Alan Greenspan blew up a bubble in housing. He didn't actually do it. It was Frank Dodd and Barney Frank. They basically messed with the lending standards and said you can lend to whomever you want, even if they don't need income. So it was the government-backed loans that screwed everything up. And the ability for the banks that the governments gave them and said, loan it to whomever you like. That's what screwed it all up. It wasn't Greenspan. Interest rates. So here's another. Everyone thinks interest rates pushes homes prices higher. I don't think so. Interest rates is it chases. It's not the tail wagging the dog. The dog is the housing market. The tail that is getting wagged is interest rates. Interest rates follow inflation. Inflation is an outcome of a demand-supply imbalance of real estate. Real estate is so messed up right now that you could have higher rates, it won't even matter. The homes that are being sold, a lot of them in Colorado Springs, they're all cash offers. You can't even get a house if you're trying to get a majority loan on the house because you're viewed as a higher risk transaction. So, I mean, these people they're having to come up with $100,000 out of their pocket to buy the house if they're offering $100,000 over asking, because I don't think you can get a loan for that much. So you obviously have to put down quite a bit. You're gonna have $300,000-$400,000 at least on a $600,000-$700,000 house. And I know a lot of people, I think they're asking the wrong questions. The wrong question to ask is, how are people going to afford homes? Wrong question. Wrong question. A better question would be, what people in the future, how much money and how much wealth are you going to have in order to buy a house, period? These people won't be buying homes. They're going to be priced out of the market indefinitely. And one thing that you should be worrying about is lumber prices are going up. Yes. How high are they going to go up? And what is the cost curve going to look like for lumber? How high is it going? When it goes all the way up, how far back is it going to pull back? That's the right question. The wrong question is, it will come back, things will come all the way back down. No, they won't. We have inflation, and if inflation comes, here's another thing. I'll pull it up because it seems like seems like a lot of people don't understand what's going on here. This is what I have behind me is money velocity. All right. Velocity of M2 money stock. I'll move you over here because I know some people like reading left to right. Velocity of M2 money stock. We've been going sideways, and this thing's been declining. The way that they got this to decline is they created copious amounts of money ever since 2008. This big move down could have a constant velocity, but if you dump just trillions of dollars into a system, or billions at that point, it was hundreds of billions, your velocity goes down. It's in the equation. It's just a basic arithmetic equation. It's not hard. This is what's going to happen, or potentially could happen. This is going down. Velocity isn't declining in the system. They're pumping money like heck into it. And if in the denominator, if your money that you're putting in base money is being pumped like mad, your velocity is going to fall naturally. Now, here's the thing. You've got massive inflation, which isn't manifesting itself in prices. Prices are a symptom of a couple of things. It's a symptom of inflation, but it's also a symptom of the willingness of people in the system to transact in the system. You need a catalyst. You need something or a demographic to change the velocity of the money. So in 1980, 60s, okay, so Gen X, 64 to 80, roughly, is the Gen X population. The Gen X population is a smaller cohort. That cohort is smaller, which led to a disinflationary period of roughly 40 years. 64 to 1980 is about 40 years. That demographic was smaller. The velocity during that time frame declined. Now, the millennials are bigger. The millennials they're bigger than the baby boomers. They're coming into home buying years. They're coming into kid making years, so to speak. They're going to be spending more money. And guess what happens when you spend more money? You're going to see a velocity kick up some. Velocity is going to kick up. And this little kick up here, this little thing right here at the end, that velocity being kicked up just a little bit is causing inflation. Now, we just primed the entire system with trillions of dollars. They just pumped it. And my thesis here is an expansionary phase of real estate is inflationary. They're making larger and larger loans into the system against homes that cost more money. And then they're going to have to build their way out of this. We're 3.8 million homes in deficit, and we have to build 3.8 million homes above the yearly demand of 1.5 million over this next 5-10 years. So we're in an expansionary phase. It's going to be inflationary. You're also going to have pressures from the demographic kicking the velocity of money up. If this all happens and you've got trillions of dollars in the system, your question isn't when's the next crash. The question isn't I'm going to wait for home prices to come back down. That's the wrong question. The right questions are, well, what could lumber and copper fall back down to if we have a slowdown? That's a better question. A really good question is, if we use copper unabated, how fast can they bring the copper back online? Freeport's CEO said a statement that was, if copper was $10 a pound right now, it would take me 8 years to get more copper online. What's going to happen between now and 8 years? Guys, copper could go to like $20 a pound. There's nothing, I don't know where it's going to stop. And if you've got this velocity kick back up, I don't know, like, I'm not worried about a crash. I'm worried about a problem with inflation. I mean, why do you think I hold so much physical metal? Like, you guys are looking at stocks can crash. Stocks are probably going to crash. You just may not know it. They may be crashing right now. And what I mean is, you need to start looking at the ratios. You could see stocks go up, and then commodities just absolutely take off like a ray Dave. And that's what we're seeing. I'm afraid that it's going to go unabated. Like, they don't know how to stop it. What if oil goes to $200 or $300 a barrel, like by 2 years or 3 years? What if copper goes to $20 or $30 by next year? I don't know. It's probably not going to happen. I'm just asking the question because what you could see is if that velocity kicks up, your interest rate kicks up, everything gets priced off interest rates, and then you see a massive rotation of money very quickly. That potentially could happen. Because you've heard me talk about this for many, many months about the rotation of money and interest rates. If they lose control, the Federal Reserve, if they lose control of interest rates, that rotation of money, remember, everything's priced off interest rates. If stocks are priced off interest rates and interest rates go up 1% or 2%, what's going to happen? People may sell out of stocks. Now, does that create a crash in stocks? I don't know. They're trying to prop all this stuff up. Maybe they go out and they're buy it. I don't know. But I'm a lot more worried about that big rotation of money, and I'm going to be in those sectors that money's going to rotate into. I'm just sitting in them. And my worries are less about a stock market crash, because we just had one, and the probabilities of just having one are pretty low. But if you look, we are in an expansion phase of real estate. Historically, crashes don't happen in expansion phases of real estate. It would only be contained to stocks, and stocks have not affected commodities under these conditions. That's what I wanted to get straight. But I am more afraid of inflation. I am more afraid of their ability to control it. I'm more afraid of that velocity kicking up and then having really bad problems with inflation. And that's why I think everyone should have at least some physical precious metals, at least some. And Bitcoin, or cryptocurrencies, we don't know if they're an inflation hedge. We don't know anything about it. And you know what? They are extremely speculative. I don't think they're based off of their utility, which is basically zero. I would be very, very worrisome of holding those things. That's my opinion. You guys can obviously disagree with it, and I'm fine with that. But I'll share my opinion on it. So that's my opinion on all this stuff. Watch this chart behind me. I looked it up at Fred velocity, money velocity. Fred, money velocity. You can look at this chart that's behind me, and if that thing starts kicking up, watch out, because you're going to see massive inflation. You're going to see that dollar tank, just like we're seeing. Just like we're seeing. You know what happened in Germany in the hyperinflation? Stock prices went through the roof. They had a big stock market bubble. Then all that focus turned to gold and silver. Then gold and silver took off and blew everything out of its water. Stocks went down 80% in purchasing power against gold. But stocks went up the entire time. So I'm not saying we're going to have hyperinflation, but the conditions are there. They pumped the system full of money. They didn't see higher prices. They took advantage of that. They pumped the system. The system's got the money. It's all there. Now it's just the velocity. We're in an expansionary phase of real estate. Velocity kicks up just a little bit. You can see last one. This is the last kind of bull market in commodities, this little increase in velocity. You pump the entire system full of trillions and trillions of dollars, you get this thing to come back up because of demographics. You're going to see massive inflation. All right, guys, let me know. Put in the comment section what you guys think. Thanks for listening. This is Finding Value.